All right, well, good day, everyone. Welcome to today's webcast entitled HRAs Have Become an Employer's Best Friend. And when you think of best friend, you think of happiness, right? You think of smiley faces. So I'm really looking forward to today's webinar, because I'm going to focus on a lot of happy in this webinar here today. So we are thrilled to have you. Let me introduce myself. My name is Steve Jackson. I'm the Senior Vice President of Strategic Development and Channel Sales here at PrimePay, and we are thrilled to be able to bring to you each and every month a webinar that's focused very strongly on technical guidance to sales strategies, but ultimately through it all to deliver practical applications so that you can take the information that you were just taught or you just learned and be able to go to your clients immediately, provide communication and direction and support for those various topics and those various subjects. So we're thrilled to have you. You guys have many various other types of schedules that could interfere, and we're thrilled to have each of you here on today. We have quite a few folks on, so it does show that this topic is very near and dear to your hearts. Each month, this webinar is really devoted to benefits brokers. Our partners or referring partners that we have here at PrimePay, and again, we are thrilled to have you here today. Let me just run over some of the logistics here of today's webinar. We are recording the webinar today, and it will be posted on our Broker Concierge YouTube channel. Here, generally, just give us a couple days, but generally it's posted here by the end of the week, and we will, though, be sending an email to you to let you know that it has been posted, so you will see that from us. Also, we do want to hear from you today. There are a lot of technical items that I am going to cover, and I am sure, as you guys have shown in past webinars, you guys are okay with asking questions. So we want that. I covet that. So in the question box, if you go to the Go to Meeting menu bar, go to the question box, please go ahead and type in your question. Given the content here today, I may not be able to fully answer those here all today. I may be able to, but may not fully. And we will simply just take those offline and get back to you with answers to those questions afterwards, okay? So please ask the question, because we do want to address those and ensure that you have your answers as you go see your clients. So HRAs, as we get started here today, we do have a lot of content. There's just some good stuff here today. We've got a lot of things that we're going to cover. And as we think about HRAs, I guess as I got in the industry from a TPA benefit service industry here, more than a dozen years ago, 2004 became a very monumental year in the scope of HRAs. It's kind of the rebirth or birth of health reimbursement arrangements. And since 2004, although changes have been afoot, the Affordable Care Act has been enacted, HRAs have continued to provide a great amount of flexibility, but all in all has created happiness with you as a broker, but also with clients and employers that utilize this benefit, and employees as well. Receive that same general happiness with the HRAs. But one of the things that I had noticed, and let me get my clicker working here as we get started, I just came across this yesterday in regard to a Benefits Pro article. It was written about a United Benefits Advisor agency agent out in California, and it honed in on their annual United Benefit Advisor annual survey. And I just, as we look at, everything is not rosy. There's pros and cons. There's advantages and disadvantages to everything. And I thought it would be important, since this had just come out, that I'd share a little bit of the results, because HRAs, and much like other pre-tax benefit accounts, they have all gotten stirred up due to President Bush talking about, consumer-driven health plans. He was probably one of the first to kind of mention that, and in the use of HSAs and HRAs and even FSAs to accommodate more consumerism in healthcare. But I thought this was an interesting piece that I garnered here from the article here just yesterday. this plan, if you guys have ever looked at the United Benefit Advisor survey, generally it's published each year. It is based off of 10,000 or over 10,000 health plans. It's a very comprehensive survey, really, really good. And so the results that they derive from this report each year, it varies because they're talking about several different things within the report. But a part of the report, it talks about the consumerism and the the use of pre-tax benefit accounts. And so I thought this was interesting, these two key points. So the results were that 24% of all health plans offered were either an HSA or HRA, and honestly, that's not too far off from what I've seen before. A quarter of employers out there today are offering an HSA or an HRA plan. However, what I thought was a little interesting was that this constituted a 29% decrease in the number of health plans nationally, meaning there's a 29% decrease in utilizing HSAs or HRAs across the number of these health plans that they were surveying on a national basis. So that means fewer employers were adopting these types of plans. Now, there are probably many reasons for that. There are some reasons that, there are certain regions or territories, areas of the country where, HRAs are just not a good fit. Here in the Northeast, tremendous amount of energy over the years in regard to HRAs and HSAs. I mean, Connecticut was one of the first states to really fully engage and embrace health savings accounts. And so, there's strong use of these accounts. But then there's other states, other areas, regions, where it's not as strong. But I found this kind of interesting. And so in the article, they had focused on a couple key reasons, and I've added the third. But the two key reasons that they had cited, which I thought was interesting, was that plan designs that have been used here in this past year have resulted in smaller pricing gaps. The spread between a traditional and qualified high deductible health plan has been reduced. There's smaller gaps there. And so employers may be choosing through all of this, more traditional style plans because the price difference is not as great. But also we have in the second bullet point there that insurers have added restrictions disallowing employer-funded accounts. There are specific carriers in certain states that have just disallowed. We're not even allowing you to utilize an HRA. And then the last one I have put in regard to where I think too, what I see consistently, a benefit broker's energy and focus has been redirected quite a bit in this past year. I mean, in 2015, I must have said the ACA reporting requirements, quote unquote, 5 million times it seems like. My energy and focus was centered around helping brokers and clients through the ACA reporting obligations and those requirements. And so there's been other priorities that brokers have really been focused on. And again, not putting everything on the broker, but the employer has been not as focused. They've had other priorities that they've need to focus on. And so I think that both plan designers and health plan sponsors are out of sync on the value of these accounts, not that they don't totally see the value, but are not inherently putting the value of these accounts in coordination or in collaboration with their major medical plans and utilizing it on a much more frequent type of a basis. So I thought that was interesting. As I begin our discussion today, just this thing is just out. It was a great article. Recommend for you to look at that as well. So as we look at our agenda, I do want to cover a lot here for you today. But I want to talk about what's going to bring the most happiness to your clients, to you possibly. But I want to focus on these key areas. So we have two plan designs that I want to share with you that we feel bring the utmost happiness to your clients, but also potentially to employees. And then I do want to take a little deeper dive into 5 key areas around the IRS Notice 2015-. Please take notes as I go through this, because I'm going to cover each of these areas, very important, and so I'm going to cover each of these in greater detail, provide some key items for considerations that you need to apply. Some of it is standard information that you may have heard before, that there may be hey, we're just kind of stating this again. However, there were a couple other key points that they've added as part of this guidance, and that's what I want to try to touch on. Then I do always want to talk, we always try to provide some bonus kind of topics in here, but again, all related here to benefits, ACA, HRAs. There was a recent bill submitted by Senator Grassley of Iowa, so I want to talk about that specific bill and what does that mean, what could that mean to HRAs, and then also get your heads in gear in thinking about the COLA increases for the penalties A and B, which I will go over. So I would be remiss to think that just everyone here on the webcast here today knows everything they need to know about HRAs. And so I literally, so I want to just talk about the basics, but I'm going to go through this pretty quickly. And I just put a lot on the screen here, so let's go through this. But I just want to lay a level playing field for education and content here for what I'm talking about in regard to HRAs. So I put this in here because I see a lot of people adding different words for what an HRA stands for. So I'm giving you and providing you here what it actually does stand for is Health Reimbursement Arrangement. It's not a health reimbursement account, a health payment account. The IRS now calls it Employer Payment Plan and so forth. But an HRA, as it's acronymed, is a health reimbursement arrangement. So if you think about it in simple terms, it is an account. It's employees are given this account, a spending account, an HRA, to use for predetermined qualified medical expenses. And this is 100% employer designed. Not with the help of the broker, of course, but it is employer design. The employer designs an HRA that best fits their specific needs of their health plan of their employees, okay? 100% employer design. An HRA will cover clearly employees, but it also has the ability to cover former employees, and not just necessarily through a COBRA qualified type of an event, but it's through like a retiree that would be there. You don't see that a lot in some other types of areas for like a health FSA and so forth. So very unique to have the ability to kind of cover even former employees. This is 100% funded by the employer. Nowhere can you have an employee taking salary reductions to be used to fund an HRA benefit. Okay, so 100% funded by the employer, which means that when reimbursements are made, it is tax deductible to the employer. So kind of no duh there, but that's a tax deductible item then to the employer. Which also, the great benefit to the HRA means that the HRA reimbursement is tax-free to the employee. So the employees that participate in this benefit can reap the tax-free reimbursement of this benefit and reap the 100% employer-funded piece of this benefit. An HRA is also COBRA qualified. So for whatever you may hear over time, an HRA is going to be COBRA qualified. So, an HRA is going to be integrated with a group health plan, and generally speaking. And so as events occur, the major medical plan will be COBRA qualified, of course, along with the HRA. And so the HRA would need to be offered as a COBRA qualified benefit to that qualified beneficiary, okay? And then the last two items, very important in regard to an HRA. You cannot just state, hey, we have this available benefit, employees, please use it, or please submit reimbursements as you incur expenses. Plan documents are very much required, and they're required under Section 105. So a plan document is needed for the employer. A summary plan description is needed. Summary benefits of coverage are needed, as well. So the plan documents, that compliance piece is very important for any HRA that is being implemented. And then lastly, and something that I think is often overlooked, but under Section 105 there is specific. So if you think of Section 105 and self-funded plans, okay, no different than a regular self-funded major medical plan, non-discrimination testing is required. And so you need to ensure that the benefit that you're providing is not just benefiting they're not just benefiting the highly compensated employees, but they're also benefiting clearly the non-highly compensated employees as well. So very, very, very important there that is done. The greatest, if I could pick a word though that would best describe HRAs, and it's a word that is flexibility, that is now on your screen, flexibility. I'd like to say that an HRA is somewhat a kind of a snowflake. I mean, some people might call it that. You really can have, if you had 10 different employers with an HRA, you could have 10 different plan designs. I mean, that is very much true. But it provides the greatest amount of flexibility, which I feel provides the greatest amount of happiness, certainly to the employer, because they can truly implement and design a plan that's going to best fit their health plan needs, their financial needs, but also the needs of the employer. So let's dig into this here a little bit. There are two very happy HRA plan designs that I want to share with you here today, and share with you a few quotes along the way as well. And Leo, I love your quote. If you want to be happy, be. Think about that. I want to be. So let's move on. Let's look at these two very happy HRA plan designs. The first plan design that I will go through and go through quickly here to some degree is I want to share these two plan designs that are and to some degree, this first one might seem more complex, but when you break it down, it is not complex at all. And this is one of my most favorite HRA plan designs on the planet here today, because it does so much, not only for the employer, but also for the employees. So let's look at an example here, and what I show on the screen is an example of a qualified high deductible health plan. This is a high deductible health plan that is an HSA compatible plan. It is, let's just assume, it's a PPO plan. It has a $3,000 single, $6,000 family deductible, and once the deductible has been met, it's covered at 100%. Now, a couple things to keep in mind with this, okay, before we just throw in an HRA here a second. I've just stated that it's an HSA compatible plan, which means that an employee, an individual participating might have the capability to be able to contribute to a health savings account. Okay, but there are some certain rules in place with these types of plans. In order for you to be eligible to contribute as an individual, you cannot have any first dollar coverage. And so a minimum deductible cannot be touched or be, where something else comes in before that $1,300 or $2,600, because that would be considered first dollar coverage. So the HSA minimum deductible for 2016 is $1,300, $2,600. So regardless of the overall deductible of the plan, the HSA minimum deductible that has to be satisfied first with no first dollar coverage is $1,300, $2,600. So what's nice about this benefit is that the employer is, they've gone to a higher deductible health plan for employees. That could be very expensive if they were to actually consume their health care and incur those expenses. And so having an HRA that would come in once the minimum deductible has been satisfied, $1,300, $2,600, that they would reimburse the remaining $1,700 or $3,400 family is a wonderful benefit if an individual would have catastrophic kind of coverage issues. All right, so I want to look at just a few funding consideration, or not funding consideration, just considerations here, 4 different considerations to make based on this plan design. First off, when you pair an HRA when we just talk about an HRA, I had told you kind of in the HRA basics that the reimbursement made to the employee is tax-free, and the employer, when reimbursed, creates a tax-deductible expense to the employer. So taxes are fantastic. Now, an HSA, getting into tax savings there, an employee can make pre-tax contributions to the HSA. The employer can make employer contributions to the HSA as well. And there's FICA savings realized for the employer. There's total taxes, for the most part, federal, state, local, Social Security, and Medicare, on the HSA contribution. So from a tax, when you look at this particular plan design, the HRA is providing a tax-free benefit. The HSA is providing that tax-free benefit. Funding. Now, in this example, what I showed you, since the HRA, one of the questions states here from the audience is, can the HRA pay first dollar? Well, they could. They could pay first dollar, but by doing that, the HSA contributions then cannot be realized, meaning the employee would not be able to open up an HSA and then fund an HSA account. And you'd want them to do that because they're in an HSA compatible plan. They're eligible to do so. So by creating it in this fashion where the HRA does not begin reimbursing any expenses until that $1,300 or $2,600 is realized, this enables the employee or employer to fund their HSA up to the annual limits, not just up to the $1,300, $2,600, but all the way up to the $3,000 number single and $6,000 and more, and I'll show you that here in a second. As far as the annual limits, they can max that out. From a compliance standpoint, clearly with an HSA or an HRA, you got to follow the rules. You got to have plan documents in place, summary plan descriptions for the contributions under a cafeteria plan. You're going to need to update your Section 125 plan documents to do so. Okay, and then lastly, I talked a little bit about COBRA. The major medical plan is going to be COBRA qualified, of course. The HSA is not, but the HRA is a COBRA qualified event here. So this plan here is really, truly the best of both worlds. It enables an employee to max out their HSA contributions, but then all the while have the protection that if they or their family incur expenses that blow through their deductible in a given year, that the HRA is there to actually protect them from that. And when you think about from the employer side of the aisle, the employer's utilization will go down because not every employee is going to blow through $1,300 or $2,600 of the deductible, and so the utilization of the HRA benefit for the employer is not going to be as great. So a very strong advantage for the employer. The key advantage to all of this, if I could say, that's a key part of this design, is the HSA, and it's truly, I'm focusing today on the HRA, but this plan design, which is, when you think about HSA compatible plans today, majority of employers today offer an HSA compatible health plan. And so most of these are not necessarily the lower forms of the deductible of $1,300, $2,600. They're much more than that. And so as an employer that's offering an HSA compatible plan, you want to give the ability for each and every individual to actually open and fund an HSA. And that's where that HRA coming in as a post-deductible benefit that you can actually utilize both benefits. The employee reaps the rewards of both of those. So the HSA has ultimate savings, right? Pre-tax contributions, tax-free growth, tax-free distributions for qualified eligible medical expenses, and then certainly additional FICA savings for the employer. I put the contribution limits there up on the board. So you have them here for 2016. But in the plan design that I showed, as long as the HRA is not reimbursing before the 1,300 single or 2,600 family deductible has been met or has been satisfied, the employee has the ability to put in the full annual contribution limits to their HSA, $3,350 single, $6,750 family, and then the catch-up for 55 and older of $1,000. And so what this enables then is the employer to make decisions based on how or if they wish to contribute to the HSA. They could offer fixed dollar contributions, matching contributions. They could offer it under a cafeteria plan, outside of a cafeteria plan, as far as their own contributions to the plan. And then you do want to be specific as a benefits broker, as you're consulting with the employer. Do you understand, you can make contributions as an owner to an HSA, but based on your status, you may not be able to make a pre-tax contribution to that HSA. Another very strong plan design that is being used more and more, and why it's being used not only with qualified high deductible health plans, but with any traditional high deductible health plan that is out there, is what's called an HRA percentage split plan design. This is bringing some very nice happiness to employers here today, and I think to your clients. So let me just share a little bit. So you have an employer that offers let's just say in this case, a high deductible health plan. And I don't put it on the board as far as what the deductible size is. Quite frankly, it doesn't matter. Any high deductible that's part of that health plan. The employer, many plan designs that employers use today with HRAs are based on fixed amounts, meaning, okay, employee, you have the first, $500 of this deductible, and then my HRA will cover the next $500, or so on and so forth. And that's good. That's not bad. For many employers, that works extremely well. But we also want to talk about consumerism. We want to engage an employee maybe a little differently. We want to get an employee to think about those expenses all throughout the deductible, okay? And so in a percentage split plan design, an HRA is established to reimburse a percentage of every claim throughout the deductible. And it literally could be anything, right? 80%, 75%, 50%. To the right, I'm just showing a 80%. So where the employer is reimbursing 80% of the deductible. Sorry, excuse me, hit the wrong button. Also with this, let's assume in any type of a traditional plan, the carrier may cover 100% of the medical expenses once the deductible has been met, or clearly additional coinsurance could apply. You could see employers not selecting a 100% coinsurance model because they can save a whole lot of money if they move to a 70% model coinsurance model, right? Well, an HRA percentage split design could also be established to split the cost of those expenses throughout that coinsurance piece, okay? So it's very flexible, okay? So you also, the last bullet point there is that you could also design a percentage split to also be more expense specific, meaning like RX only. So for example, the employee could go to the prescription counter and they have a $100 prescription that they're filling here right now. We could, one debit card could be used to where it simply pays, so they swipe the card and it pays 80% of that expense, $80. And then they would be asked to use another debit card, credit card to pay for the rest of those items, okay? So debit cards can be used in certain percentage split designs, specifically around RX only. It works beautifully there. But some of the advantages of a percentage split HRA, there's actually several that I'll list here. It allows an employer to offer a much larger deductible, okay? So instead of going to the bare minimums, not that many are going that way anymore, but certainly can look at $3,000, $6,000, $4,800, $5,000, $10,000. They can look at higher deductibles here, which will grant them larger premium savings to both the employer and employee generally, and it will enable them then to maybe carry more of the percentage of those deductible expenses once they are incurred. One other nice feature with this particular benefit design is that an employer could adopt an HRA only, okay, which would cover their percentage of the expenses that would be incurred. But one other item that's huge and, again, often overlooked is actually combining an FSA and an HRA together with this particular plan design. And what this does is that it enables one debit card to be used for both plans. So in the example that I gave about going into the pharmacy, filling that prescription, it's $100. Now they whip out their HRA FSA debit card, they swipe it, and 80% in the previous example would go to pay. It would be paid for out of the HRA account, and then 20% would be paid out of their FSA account. And so what's beautiful with that is that an FSA funds, it's available on the first day of the plan year. So if their election was, $1,000, they have that $1,000 available on that card immediately. And so there's great flexibility. It's a great combo to have the HRA and FSA together. There's no large upfront deductible exposure for the employee or employer. Since you're splitting the costs together, you're saying, hey, employee, I'm in this with you. I'm going to just share this cost. This is a cost-sharing strategy. And so, you're maybe not going to get hit with this huge bill up front or at the end because you're splitting it. And that percentage is truly based on how the employer wants to cover that throughout. Employees who are higher utilizers have more out-of-pocket exposure. So, an advantage to the employer by just splitting it would just say, hey, if you're a higher utilizer, I want you to be a better consumer, though, as a utilizer. Maybe there's ways that we can work with you to assist you in consuming your health care, maybe where it's just better financially. And so it is an advantage of the percentage split for an employer to be able to see that utilization. And so we do think that a percentage split HRA does drive better consumerism, certainly has the ability to lower claim utilization since you're splitting or cost sharing that expense throughout. And you can use, possibly an HSA. So this could be a traditional plan, utilizing a traditional plan, or an HSA compatible or qualified high deductible plan to try to lower the premiums more. So controlling cost. Really big issue for employers today. A post-deductible HRA plan design and a percentage split HRA plan design can be two plan designs that could offer some great cost savings to the employer. So at the end of last year, we had IRS Notice 2015-87 that was published, and as part of our happiness theme, it had a plethora of information about HRAs, and so I'm calling this the HRA expressions and affirmations. It seems like the IRS and the Department of Labor, they have issued multiple types of guidance on HRAs since September of 2013. And so this 2015-87 was very welcome, provided some immediate closure to some issues that were out there, but also certainly re-clarified their position that had been stated before. And so I like this from Benjamin Disraeli. That's a great quote. Action may not always bring happiness, but there is no happiness without action. And I think, as we look at the IRS Notice 2015-87, I hope that you didn't just let it pass you by. That okay, it's out there. Maybe I'll get to that. Maybe I'll look at that later. It provided some immediate discussion points and some guidance that you're going to need to begin to communicate to or with your clients. So what I've done is looked at the various Q&As that were published within this notice, and I have put together 5 key talking points pieces that we're going to cover here today. And what I've tried to do is take the different Q&As that I'm going to discuss, kind of really just highlight some of this, maybe kind of, hey, Steve, no duh, heard that one before, which, yeah, true. But there's also some key items for consideration. What this technical notice did was that it actually took it a little bit further. So it stated the obvious, I would say, but then incorporated a couple other key things that you're going to want to consider. And so I've put that under my little header here, key item for consideration for each of these. So the first one that I'm going to bring up and talk about here today is in regard to HRAs, their ability to purchase individual coverage. So many of you might say, oh, Steve, have we not covered this? Well, I'd like to think that we have covered it as well multiple times, but even in the month of February here, I had received emails saying, well, wait a minute, Steve, can't I do this? We can do this, right? So, all right, let's again bring some clarity, and I think it's why the IRS sought to bring additional clarity in regard to this particular question. Can an HRA be used to purchase individual coverage? And I put a quote up here that has been a standard quote. It has been kind of ingrained in guidance since the September of 2013 guidance. It's IRS Notice 2013-54. And basically stated this, is that an HRA is considered a group health plan. And that by utilizing an HRA to purchase individual coverage, I use now in quotes, it fails to be integrated with another group health plan. Thus, it fails the market reforms of ACA and cannot be used to reimburse individual insurance coverage. So the statement here in the second bullet point is it's reconfirmed again that an HRA cannot reimburse individuals for premiums paid for health insurance in the individual market, the federal marketplace, or a state exchange. They've even gone as far as stating that an employer cannot this cannot be pre-tax offered, nor can it be post-tax offered, okay? Because and so they've said that on numerous occasions, and so an HRA that's reimbursing individuals for premiums paid for in the individual market is not going to be permitted. One of the key items, though, for consideration was actually very well noted, and it talked about terminated employees. Within an HRA, there is an availability for an employee to accumulate unused amounts, right? So they've not incurred any eligible medical expenses. They've accumulated some balance within the HRA, and now they're terminated. And so the question had been out there in regard to, well, can unused amounts be used to reimburse individual premiums? It was something that had come up here in the past. And basically what they have stated, just again as a key item for discussion, the unused amounts cannot be used to reimburse individual premiums. So for terminated employees, that's not going to be a specific option. So one thing I want to mention here is that there are still today at least a few vendors that are still offering some type of a reimbursement plan of some sort that would help an employer provide funds to an employee to pay for individual medical premiums. I'm here to tell you right now, not to dash any hopes, because we want to keep things at the happy level, but an HRA cannot be used to pay for individual medical premiums. Have I said that enough? I think I have. Let's move on. All right, the second Q&A that I want to cover is number 5 as part of the guidance. And this was in regard to HRAs and the permission of utilizing HRAs for accepted benefits. I don't want to take the time today to necessarily cover what an accepted benefit ultimately means. But it is what the market reforms, what ACA has said consistently from day one, is that the market reforms do not apply to accepted benefits. And so you saw a lot of accepted benefits in the past, definitions of accepted benefits, which is dental coverage, dental expenses and premiums, vision expenses and premiums, hospital indemnity coverage, and so forth. So those expenses, those premiums are considered accepted benefits, and they would not need to comply with the market reform. So what this means is that an HRA would be permitted to reimburse expenses or premiums for accepted benefits only. And so some key items for consideration here that you do want to be very sure of. As I had stated earlier, one of the high compliance items that needs to be used with HRAs is that you need to have a plan document. You need to have a summary plan description, an SBC, all of those things, right? So an HRA plan must be specific to and reimburse premiums for coverage that covers only accepted benefits. It sounds like maybe a silly statement, but you need to ensure that the documents that are established for the employer is very specific to that fact, that it's only covering those specific accepted benefits. And they might want to even go as far as saying specifically dental expenses or premiums or vision, be very specific in that. That way that there's no, liberties being granted in regard to what accepted benefits are. And also then, HRAs would not, if they're established this way to reimburse accepted benefit expenses and or premiums, clearly they would not be subject to the annual dollar limit prohibition as part of those market reforms. So, clearly the employer could put a limit, on those HRAs, and these HRAs are considered more standalone type of HRA plan designs because they're not formally integrated with another group health plan. All right, I am feeling happy. Let's get to this next one. This is a good one. So HRAs, another key Q&A, number one, that was found in this notice, covered or talked or discussed about covering fewer than 2 participants. Okay, so, this has been bantered about a lot in regard even to these other vendors that may be offering reimbursement strategies of some sort. But the key calculation that you want to use here is that this is covering, so an HRA is permitted to reimburse expenses and or premiums as long as that HRA is covering fewer than 2 participants. So let me see, math, if I do my math right, so that's one. That's one participant, right? So it is permitted for retiree only. So where this is used primarily would be for retiree only types of HRA benefits. And so an HRA could be established for retirees that could reimburse them for premiums. And now I'm not just talking about accepted benefits. I'm talking about a major, an individual premium, right? But we're also talking about other qualified medical expenses as well. So this particular HRA would not be subject to the market reforms, okay? The ones that's causing the other issues, and may reimburse any qualified medical expense that the HRA is designed for, and also premiums. But there are some key items for consideration, okay, that were mentioned here again. What you want to keep in mind is that the HRA is considered a group health plan. Okay, so it is providing minimum essential coverage to that retiree or to that individual. Therefore, the individual would not be eligible for a premium tax credit as long as they are covered under the HRA. So as a retiree, if they feel, well, I'm actually, based on my household income and where I'm at, I actually qualify for a premium tax credit. And if I'm participating in the HRA, I now am not eligible for the premium tax credit. So therefore, in bullet number 3, The plan document for the HRA that the employer produces must include an opt-out provision or an ability for that individual to suspend the HRA, say in that given year, and it would be a stated year. So for the 2016 plan year, if I was the retiree, wow, hey, I qualify for a premium tax credit, so I'm going to opt out of my HRA this year so that I can enroll in coverage in healthcare.gov and be able to receive the premium tax credit. Okay, so that is an option, big consideration, at least for this particular piece of technical guidance. We are seeing this, certainly more. It is certainly happening out there in the workforce, and you run into large employers and smaller employers, municipalities, union shops, all sorts that will kind of key into this particular Q&A number 1. All right, Q&A number 4. This was, as we read into this, I'm kind of like, well, what is going on here now? Why did they bring this up here again? Because they're kind of changing the game here again with this particular Q&A. So this Q&A number 4 was focused on HRAs that were reimbursing expenses for individuals that were not enrolled in the group health plan. Okay, so you have an employer that's offering an HRA, and then they offer a major medical group health plan. And so what this particular set of guidance was around individuals that may not be enrolled in that employer's group health plan. So why this has caused just a little bit of confusion out of the gate, and we'll probably need to get some further clarification from the IRS potentially, but this does not align with the earlier notice that was brought out in 2013-54. So if some of you are thinking in your heads, Steve, why this isn't seeming to work for me, this is why it is. This is where the confusion comes in, because they stated in 2013-54 that whether an individual was enrolled in the group health plan of the employer that was sponsoring the HRA or not, they would be eligible for the HRA benefit. So they stated, and I put it in quotes, it was regardless of whether the plan is offered by the same plan sponsor or not. Okay, so the focus and area that we're talking about here is where a spouse and dependent, you have an employee who is enrolled in the group health, the major medical group health plan of the employer. They also now are enrolled in an HRA that's integrated with that group health plan. And what Q&A number 4 now states is that the HRA would only be considered integrated only as to the individuals who are enrolled in both the HRA and the employer's other or major medical group health plan. So basically what it's stating is that the HRA and group health plan must be maintained by the same employer. So if that spouse and dependents were actually enrolled under the spouse's group health plan that does not have an HRA, that would not be eligible, or expenses incurred on that plan would not be eligible. Some key items to consider here, because some of you might say, Steve, really? Were there employers that did this? They were reimbursing expenses for, a spouse or dependents on another plan? Yeah, we've written plans to that here at PrimePay for clients there. So some key items to consider. There is transition relief that has been granted for the 2016 plan year. So if employers are providing this benefit to employees and their spouse dependents today, it's okay in the current plan year. But this specific item, Q&A number 4, becomes unavailable or would be prohibited for plan years on or after January 1st, 2017. So it behooves you as the benefits broker, consultant, to really just dive into their plan documents. Don't assume. Look into their plan documents. Ensure that, as far as what they are offering, are they providing a benefit in this fashion? And if so, they will need to actually amend their plan documents and move accordingly in the 2017 plan year. All right, the final Q&A that I'm going to discuss here today, which can bring, you know what? I'm going to just say it. It can bring happiness, all right? It's Q&A number 7. The HRA within this piece of guidance focused on how to apply the HRA benefit to affordability. Okay, and so I want to just again lay some ground words. I mean, you'll look at this, what I wrote up here, maybe a little bit no dub, but let's just make sure that everybody is on the same page. So as we think about affordability, this is it as it relates to the Affordable Care Act. You have an applicable large employer that needs to offer coverage, and they need to secondarily provide affordable coverage, right? So we're specifically here today going to talk about the affordability piece of this, but the affordability basics. So an employee is not eligible for the premium tax credit, that's the PTC, for any month for which the employee is eligible for coverage under an employer plan that provides minimum value and is affordable. Okay, so the employee's ability to be able to qualify and receive a premium tax credit is dependent on their eligibility and coverage and affordability by or through their employer. Okay, so when we think about affordability, we think about, or what I want you to think about, is the employee contribution. Remember that we're only basing this on self-only coverage. Okay, so what is the employee contribution for that self-only coverage? And then as you look at the actual affordability definition, it states, generally here, 9.5%, that the contribution, that the cost to the employee would not exceed or be, that it would be 9.5% or less of the employee's household income. So that is adjusted annually, of course, but that 9.5% is there. Now, what that also doesn't state is that's from an employee basis, right? It can't exceed 9.5%. Okay, of their household income, but they also then provided some safe harbors, right, to the employer under the employer mandate. So an employer could utilize the rate of pay safe harbor, a federal poverty rate safe harbor, and also a W-2 safe harbor, where they could just look at the W-2s that they're producing for their employee and not necessarily rely on the household income amount. So affordability is very important. I know as we have worked with many clients, as part of our ACA reporting and the obligation there, we've talked a lot about affordability. We've had, and as I'm sure as you have had, some tremendous conversations around that. So an HRA, I mean, so if you're running into situations where an employer is finding it difficult, or it's just they're finding a challenge in regard to creating affordability for all of the employees, we want to look at the HRA benefit. And so this guidance talked about how to utilize the HRA benefit for that challenge. So it is permitted where an HRA can be used to cover or reimburse premiums and or cost sharing. Okay, so an HRA document, the plan document, would need to state that it can or may be used for premiums or cost sharing. One of the things that I do want to say is I've received some questions recently just saying, hey, this employer has an HRA and you have to use the HRA, you have to account that benefit towards the minimum value or the affordability of the plan. You have to. The answer is no. I put may here for a reason, because it's in the regs. An HRA may be used. If an employer is struggling with affordability or potentially minimum value, they may use the HRA benefit to allow them to get there, okay? So an HRA, if an HRA, so within the plan document, an HRA plan, if it's not permitting premium, so let's say, let's be honest, do most HRAs reimburse the premiums for the group? No. Normally HRAs are established to reimburse deductible expenses or specific expenses to the plan, right? But we're taking it a little further here, folks, because I do see some questions that are like, wait, you can cover premiums? No. So what it's doing is it can be used to reduce the amount of that employee cost, the amount of that employee contribution, okay? But it has to be written within the documents. So I'm not talking about individual insurance premiums. I'm talking about the group health plan that the employer is offering, all right, to allow that employee to so that it's affordable, at least under the guise of ACA for each and every individual. So within the plan documents, the last bullet point that I list, if an HRA plan does not permit premiums, then the HRA benefit may apply to minimum value. So you can also allow the available benefit to apply toward the minimum value standard. So maybe you're trying to get the plan, maybe it's a self-funded plan, and you're trying to get it to bronze level. Okay, you can utilize the HRA benefit to actually get there. So let's give an example. Maybe this will paint a picture. I'm seeing several questions that are coming through. So the HRA, so just kind of showing an example, this is right out of the guidance. I decided, you know what, it was pretty easy to go through, layman's terms, so I'm using it. So a very good example that they provided. So let's assume that the employee contribution for health coverage is $200 a month. Okay, so again, for self-only coverage. The HRA has an available benefit of $1,200. Now, in this particular HRA plan design, the employer has allowed this benefit to cover major medical contributions, so premium contributions, cost-sharing expenses, and even, let's just say, the cost of vision and dental coverage. Again, greatest amount of flexibility with HRAs, so you can design it, word it, as you would need to. All right, so we have that down, $1,200 benefit for the HRA. So as long as that employer has put that within their plan documents that it can cover those premiums, the result would look like this. The $1,200 would reduce or have the ability to reduce that employee's required contribution. So if we take 1/12 of the HRA benefit, that would equal $100, right? Okay, so $100. So if we take the current employee contribution of $200 minus the $100, we get to $100. Okay, so this $100 now becomes this new employee required contribution for the major medical plan. Now, to $100 might get them over that affordability, puts them into the affordability category. So again, this is a opportunity. It's an additional, many employers have an HRA plan, and some may be struggling with that affordability and or minimum value. And so you might want to consider the HRA benefit as it relates to reducing the employee contribution to the plan. It very much might get them into that affordability category. What we'll end up doing is providing some additional feedback to you in regard to this particular Q&A, but it could be something that you could use with your clients here, more so here in the very near future as they look to stay on the affordability page. So true happiness comes in bonus topics, but Dalai Lama said it best, the purpose of our lives is to be happy. So hey, we're going to listen to the Dalai Lama. We're not going to question that. There are two things that I do want to mention. One is specifically related to the HRA that I thought would be very important for you to at least know. Every bill that is pushed through Congress clearly does not get passed, but I did want you to see where a specific bill that has been entered could change the game. For certainly small businesses. And this was Senator Grassley of Iowa had submitted this bill, Small Business Healthcare Relief Act. And what it entails is relief for small businesses to help their employees purchase individual health insurance. You go, Steve, what? I mean, didn't you just spend the Q&A whatever? You said that, yeah, that's right now, small businesses are barred, as you see there in the second bullet point, from giving money specifically for this purpose. Businesses cannot do it. They can't specifically say, we're going to give you this money and it's contingent on you getting yourself enrolled in health insurance. Can't do that here today. So this specific bill and act would actually create a permission around allowing employers or assisting and supporting them through this process. So this could, I'm saying could, again, it's not right now, it could open the doors for HRA premium reimbursement. Maybe keep your eyes on 1697 in the Senate there. I mean, it certainly could be something that could be passed. I did then want to touch on, lastly here, I think with the Affordable Care Act, there's a tremendous amount of requirements that have been pushed, and one of the key requirements that we talk about with the employer mandate are the penalties, right? The pay or play aspects. If you don't play, then you're going to pay, and here's what you're going to pay. And if you recall, there are two penalties, sometimes known as Penalty A and Penalty B, but Penalty A was kind of the bigger penalty, and there was a $2,000 penalty if the employer did not offer coverage to its full-time employees. So employer needs to offer coverage to 95% of their full-time employees and dependents. So Penalty A, there's been a $2,000 penalty, and what this guidance did just come out, so in 2015-87, it discussed the cost of living adjustments that have been made to this specific penalty. And so I just am pointing this out because I don't think we should say it's a $2,000 penalty anymore. It's actually $2,160. So as you can see here, the penalty has been increased up to $2,160 here in 2016. And if we just take our formula here as we have it or know it today, the number of full-time employees minus 30, so they give you a buffer of 30, and you now multiply that by 2,160. Of course, that is monthly, so that is driven down 1/12 of that. But if it was done for the entire year, if one of those employees goes out and receives a premium tax credit, you now have a much larger penalty here if it was spread out for the entire year. Penalty B was then focused on your affordability, right? So, okay, you offered coverage, but did you offer minimum value coverage, and did you make it affordable, right? So now it's kind of talking a little more towards the type of coverage that you're offering. And so Penalty B, although it's a higher amount, was only charged to those employees who would actually that would actually enroll or qualify in a premium tax credit. And so it's a much lower type of penalty because it's specific to an individual or individuals and not the entire full-time employee base minus 30 lives. So it started out at $3,000. That's now $3,240. And so the formula there, again, as we know it today, is 3,240 times each full-time employee who receives a premium tax credit. Again, many of you will ask, well, how is this being kind of audited? It is being done and handled through the new forms 1094 and 1095. So this will be given to the IRS here this year as they file their returns. So good information there a lot of information, right? Bottom line is, though, as you think about HRAs, you do truly have to think that the H, I know I said it stood for a health and health reimbursement arrangement, but H is for happy. H is for flexibility. The HRA allows, a sales strategy now to be extremely flexible. As we talked about kind of our three themes, in our previous webinars that we had this year, one of the strong business issues are for controlling costs, that employers are dying to get help in controlling costs, not just healthcare, but just general business costs, creating more efficiencies. They want to increase their revenues. And so, an HRA, you sit in the driver's seat of being able to deliver on sales strategies that can really focus on controlling costs. But what I also want you to think about is, in the plan designs that I showed you, is think about adding more. It's not just the HRA, although that was the focus today. Think about how you can incorporate the additional ways to save by incorporating FSAs and HSAs to the mix. If there was one thing that I would say that I truly need you to do and manage is reviewing plan documents. Many employers might have old documents or just documents that have not been updated anytime regularly. There's been enough recent amendments due to ACA and otherwise that would say, hey, they need to get updated plan documents. So take the time to review, or take the time, send them to PrimePay. It's for us to review, and we'd be happy to look things over. So you want to focus on those specific, in the Q&A that I talked about, HRAs reimbursing for expenses for a spouse and dependent that's on another health plan. Group health plan, we have the transition for this year, but that ends in 2016, or that plan year. So you want to look at that. Plan specifics are really important. If you have an HRA that is reimbursing accepted benefits, boy, make sure that it's real specific in the language, that that's indeed what it's reimbursing. ACA compliance, now begin to think a little more, possibly use it as a strategy, funding strategy, to see how the HRA might be able to provide affordability or minimum value support, right? So in the examples that I provided, it might enable you to be able to get over that affordable threshold that's needed, or that minimum value threshold that's needed, based on if you have a self-funded plan or otherwise. But lastly, just be happy. I mean, why take the time to be sad? Let's just be happy, can't we? The last thing here that I'll show you here today is we do have an exclusive promotion right now for our Broker Concierge partners to clients, and we call it our +1 referral program, and it's as simple as this. If you submit a referral, so an opportunity for PrimePay, if you submit that through your broker community portal, we rolled out last year a very dynamic and informative portal for our Broker Concierge partners, where you have access to the latest and greatest briefs, content, education, libraries of information on many of these strategies that we're even talking about today. And you can view your accounts, view commission statements, do so much more there. A great way for you to communicate with your local channel manager. But what happens is when you submit that referral, your referral becomes a client. Your client's going to automatically earn a $50 Visa gift card, and you earn a $100 Visa gift card as well. So a wonderful opportunity here for you to be able to deliver, actually little extra savings here to your client. So please take advantage of that. That's on a limited time basis, but is available here over the next, I don't know, I think that ends here around the end of April here. So as you look at the content here today, quite a bit of information, but I do want you to think about, as you're having your, your regular conversations with clients, and you're taking a deeper dive with them about not just healthcare decisions, but also their regular business decisions. Think about how you can control cost even more, and utilizing an HRA and other items like an FSA or HSA to be able to deliver on controlling greater amount of costs, not just a deductible cost for the employee, but also tax savings for the employer, an ability for an employer to choose maybe a different type of traditional or qualified high deductible health plan that they can now incorporate a lower premium. It costs less to go into that plan, but now they can wrap an HRA or an HSA or an FSA, combine that in the mix to greatly assist the employer financially, but also helping the employee get through how they consume their health care. Really big piece. So I hope that you enjoyed the content here today. Actually, I hope that you're happy with the content here today. Life is full of choices, and I choose happiness. I don't know. That's my quote for the day. I do choose happiness most of the time. So I hope you will too. Please join us here next month. We are going to have a very strong webinar again. A lot of great technical guidance that have been coming out recently from ACA to otherwise, and we're going to talk a lot about just some nuances of those things. So please stay tuned for the invite that will come shortly. You will find a recording of this webinar today on our Broker Concierge YouTube channel. Please go there. Our Broker Concierge partners, you will receive a copy of the presentation here today. So you will have a copy of the slide deck, and we also have a couple other very nice items and tools that we'll be able to give you to help you talk more about HRAs and how to deliver happiness to your clients. So be on the lookout for that in our follow-up email. So with that, that will conclude our webinar today. Thank you for attending, and we look forward to talking to you next month. Have a great day.